CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of August 26th to August 30th, heading into a long weekend, investors had another round of data that seemed to keep us on course for an expected September rate cut. PCE, the Fed's favorite inflation gauge, was right on target, and other data support the narrative of a soft landing. The second GDP reading was better than expected. Retail earnings were a mixed bag, but consumer confidence is up. Manus, many investors are probably happy to close the book on August volatility and move to that September rate cut. And as Powell has said, the time has come.
Yes, he did say the time has come. Powell in the past has used it to reveal new thoughts and directions and so forth. This was about as boilerplate as you can get. People were expecting him to pivot and point out that the time for rate cuts has come. He delivered that. He added some narrative that the U.S. economy is doing fine. And all told, it was a non-event event. We all are sad that the summer is over and it's time to put away the beach gear and get back to the grind. But it was a volatile 2 months. We saw a lot of events geopolitically, politically, economically. We had that near-death experience for the markets in early August that really rattled everybody. But I do think we're coming out of the month in a pretty good spot. We know interest rates are coming. We know that, at least from the Fed chair's perspective, that the U.S. economy is doing pretty well. We'll get into retailer earnings. That was a little bit puzzling, some of the stuff that we saw. But by and large, I think that in a continuation of what I've been saying, I think for 6 weeks, that there's a significant portion of the analyst community and the investor community that believes that the landing will be very bumpy, if not hard. And I think that if I were to lay chips on the table, I would say that the landing will be tilting more towards the softer side. I think we'll be surprised pleasantly by earnings coming forward. And I do think that we'll be surprised by the level of CRE activity that we see. Are we popping corks as of 12/31 other than for the fact that the ball is dropping? No, I don't think that we're thinking this is a great fourth quarter. But I do think it surprises to the upside, and people are feeling a little bit better come December than they are today.
What's interesting about the Fed meeting in September, if you think about it, it'll be the first Fed Wednesday of this year where we're not going into it, scanning the news at 2:30 to see, will the Fed cut? This is the first time where, the answer is probably not going to be no, not yet. More of how much will the Fed cut it by? I think most of the money is on a 25 basis point cut, and that we might see a few more before the holiday scramble hits us. The expected boost that the market sees from the rate cut, whether that overrides any tapping of the brakes that we might otherwise see in a presidential election year. There might be so much activity that moves into play that there's no presidential election pause that we saw in the past. I put a lot of stock in the GDP numbers. It was nice to see those get bumped up. The strength of the economy is one thing that's really helped not just commercial real estate, but the overall market.
We were looking at a couple other data points, and you were talking about this earlier, Manus, retail earnings. It was definitely a mixed bag, and it did underscore what we've been talking about, which is that the consumer is discerning and looking for values and finding ways to shop more economically. And if you dug into what you saw out of Nordstrom, and some others, you saw that in spades, right? So Nordstrom was lifted by its Nordstrom Rack brand, which is an off-price brand. And then you had also interesting but puzzling development at Dollar General, who did not have a good earnings quarter and report. And actually, a lot of it had more to do with execution. They're competing, obviously, with the likes of Walmart and others that have omni-channel delivery and other things.
It was a very head-scratching set of earnings that we saw over the last 2.5 weeks, starting with Home Depot, I guess 15 days ago, give or take. Really a bifurcation of what we're seeing in that, in many cases, firms beat on earnings, beat on sales, top and bottom line, came in better than expected. Yet, almost unanimously, firms were coming out saying that we feel the consumer is tapped out. And maybe that's not the exact term they use, but there was this concern that they had seen this spending turn. Macy's had mentioned it, Home Depot and Lowe's also had referred to it. Kohl's talked about raising guidance, but also saying there was some opaqueness in the future. Urban Outfitters blew away earnings, but said that the end of the quarter saw a real turn in momentum. And then you get the real paradox, which is while everybody at the low end of the market is taking off, Target and TJ Maxx and Walmart, Dollar General, which is really the lowest end of the market, gets slammed and watch their stock fall 30%. So maybe this is the time where that COVID spending has just completely petered out, right? That the tail was longer than we thought, that even though we're now 2.5 years since the last stimulus, that there was this long tail there, and only now are people just finding out that there's nothing left in the kitty. I mentioned this a few pods ago where, a year or two ago, you drive by a Burger King and you'd see, $200 signing bonus, $16 an hour, choose your own shift. Demand for workers was just extraordinary. That's one thing which has gone away. We talk about the stimulus money kind of petering out. Do you both have an opinion on which is the bigger factor? Are people more nervous, do you think, that jobs are not nearly as plentiful or as lucrative as they were 2 years ago? Or has the kitty just gone dry, or is it just a combination? I'd love both of your thoughts on this.
The job listings is more concerning. And when the general population starts to see those opportunities go down, then that's a bigger concern, I would say. But it is a combination. They're both obviously very important for fueling the economic engines.
What do you think, Martha?
I think it's both. I think a couple of things, right? Post-pandemic, it was not just the extra savings people had. They actually had fewer expenses that had to do with going to work, whether it was commuting or driving or some of the ancillary things, your clothing, the food that you eat, all of that. So people saved a lot of money over those years where they were hunkered down and working predominantly from home. I think, though, that the job market has changed, and we know it, I think, anecdotally. We see it in the numbers. You saw that the Conference Board consumer confidence number went up, but the feeling and sentiment about jobs is actually not as good. So you have an overall sentiment, I think, that people feel that the job market isn't in as good a place as it was. And we talked about this before, where people were leaving jobs for another rate in salary, a better compensation a couple of years ago. And it was tough to keep people in the seat than maybe a year. You have a whole different market. You have a whole different set of dynamics. And we haven't talked about the housing market yet. People are kind of stuck in their house right now because you can't either afford the price of the home right now. Case Shiller's number came out and it was the highest that it's been in June was a new record high. You've got people that are probably got the golden handcuffs in the home that they're currently in.
Yes, we did see those home numbers. Las Vegas, New York, again, just shooting up almost double digits or even more than double digits in some cases. No relief there for the homeowner. But I do think you bring up another great point, a third factor, which I hadn't been thinking, which was the kitty was supported by this reduction in costs, commuting costs and other things. Car insurance costs during those 2 years came way down. Now it's shot up again since COVID ended. So that's a great point. This is hyper anecdotal. I'll point it out. This one. This is just one person's observation, but I was talking to a senior executive at a firm recently, and he says in the past that in average years you see 10% turnover in your company. People get up and leave and find other jobs, and that number went up significantly during COVID because of the reasons you articulated, Martha. This year, he said we only saw 2% attrition, and that was because people don't feel that the opportunity is there to jump, or a bird in the hand is safer right now, given the uncertainty we're facing in the jobs market. Great conversation, though, and we urge our listeners to come in with their thoughts. Thanks for all the questions, by the way, that have been coming in over the last few weeks. We love hearing from you. And if you have thoughts on this, we'd love to hear about that, and we'll address them next week.
One stat that scared me a little bit, I don't know if you saw it, but it was Zillow that reported that a $1 million starter home is now the norm in more than 200 US cities. 237 cities across the country have a starter home average price of $1 million or more versus only 84 cities in 2019. So, first of all, I'm thinking I don't want my kids to move back home after college. But also, on a more serious note, it really kind of underscores the ongoing home affordability crisis. And I think the importance of low-income housing options being built into some of the new development projects that we've been talking about on the pod over the past couple of weeks.
That's something we should peel back in a later podcast. But I do think that $1 million number is going to accelerate demographic changes that we've already seen taking place for the last 10 years. People moving out of California, employers I'm talking about, to reduce the cost of living for their employees, to find employees that demand lower income because the cost of living is lower. We've seen that wave from California to Texas and other locales for the last 10 years. I think this only accelerates that. More locales will benefit from that. These places where you can get a $300,000 or $400,000 house in the Carolinas, in Georgia, in northern Florida, the Panhandle, things like that. I think that could really accelerate based on just perpetually high cost and limited supply.
Let's turn to the Lightbox data dive. We've talked in previous pods about how we track investor interest in different asset classes and specifically at non-disclosure agreements. Dianne, why don't you give us an overview of what we've seen in the last quarters?
The two classes where we're seeing the most interest in that latest data on average NDAs is multifamily and retail. Multifamily listings in the RCM platform, they account for the highest segment of property listings. They have a solid 1/3 of every property listed in the platform is multifamily. And the average number of non-disclosure agreements that's filed per listing is now at 140. Now, that's significantly higher than the 105 average across all properties. And if you're following the news, multifamily is certainly taking its hits. There are a lot of distressed loans that were originated based on aggressive rent growth, based on low interest rates, which obviously didn't hold, and those loans are coming due. So it's adding to distress. There's a lot of geographic disparity. Some properties in metros like New York City and San Francisco and Chicago are seeing growing distress. There are others where there's a slowdown in new development that many are hoping will bring stability. There's strong demand, especially as the prices of homes keep going up, which we just talked about. So there's some hopefulness in some metros that there'll be rent growth. I'm talking about metros like Philly, like Denver, like Phoenix. Certainly others are going to struggle with slower rent growth and higher vacancies. The NDA data is an indication that would-be investors are looking. The average NDAs again is 140, and that's higher than the average across all asset classes. In retail, is the average NDA is not quite that high, but still strong. We've seen growth in the average number of NDAs for retail go up from 98 last year to 113 now. So that's over the 105 average, and that's on top of the 19% growth that we saw in the number of retail listings brought to market since the first quarter. So that also reflects on investors being curious about retail. I've talked to a couple investors that never bought retail before, and now they're shopping around. We're starting to see a rise in things like new adaptive reuse of existing properties to create like new shopping centers and super upscale mixed use. And many of them feature some of the retails that you just talked about, Martha. And one final point is I wanted to mention that our colleague, Greg Kaiser, was at the ICSC conference in Orlando this week, and Greg came back and said, look, there was a growing sense of excitement, a sense maybe that retail rents were stabilizing, and certainly a hope that he heard that things will be picking back up late this year and into next year.
I think two comments on your observations, Dianne, and that was a great summary of what we're seeing, and it does underscore that we're seeing more interest. I do think that this march from a 5% 10-year treasury to what is now about 385 or so has gotten people teed up to get ready to pull the trigger. And if we start seeing the next move to 360 or 350, I think people will find a lot of pressure to not pull the trigger and jump in and buy properties. How do you explain to your investors that when cap rates were 175 basis points higher, when we were at peak inflation and you started to see things coming down, when rates were starting to fall, how did you not use that as an opportunity to lift your basis, right? Lift your basis in terms of higher expected returns and lower entry points. I think there'll be a lot of pressure, and that's part of the reason that I'm modestly bullish about Q4. My other comment, which we haven't talked about this in the past, but it was a very astute observation, and that is we did have an enormous amount of supply come online in multifamily in 2024. That was, the python swallowing the rabbit, right? It was expected. It was expected to weigh on the markets. Increased supply would push rents down. We are now at the point, in my opinion, with rates on the cusp of cutting down, Fed funds rates, I'm talking about, floating rates, and with this big inventory surge getting close to the end, you have to think that if you've come this far holding on to a property, you believe in it. You're going to hold on to it. You're going to fight for this property. And that leads me to this belief that distress in multifamily will start to level off soon. That this floating rate impact, this higher cost impact, the excess supply is nearing the end of the narrative.
That makes multifamily unique relative to other asset classes because the housing crisis creates demand for multifamily. So, as the fundamentals improve that you just pointed out, there's going to be a new calculation that's done under a lower rate environment and possibly stronger rents, or at least not declining rents.
For this week, so much news is focusing on transactions coming back online. We thought we'd turn to our RCM investor platform. Did you know that in the first half of 2024, more than 40% of our principal investors looked at 10 property listings, and those were below $20 million in sales price? I'll let you think about that for a second.
I think it underscores, I guess, what we were saying just a moment ago, that people don't want to be left behind. They don't want to be left behind as rates are falling and have missed an opportunity to put money to work when prices are cheaper and competition is less. The breadth of things, when you say people are looking at 10 properties or more, they're casting a wide net. They know that different geographies and different property types are going to behave differently in this market, and it would be foolish to not look at opportunities outside your core in this market, right? If multifamily has been your thing, but you're hearing that offices are selling for 80% off and some of them are being converted to multifamily, why not at least look at the financials and dip your toe in the water and educate yourself, right? It doesn't mean you're jumping in with both feet, but it does mean that you're at least seeking out more information. And I think if I were to guess, I think that that's what's happening here.
Think about the market back in the second half of 2022 and most of 2023. The universe of listings got very small. Sellers weren't really putting as much up for sale, certainly, than they had in the boom years of 2021 and early 22. So all of a sudden, investors using the platform are starting to see more listings, so they're poking around a little bit and they have more listings that they can click on. It's interesting to see that so many are clicking on it, at least 10.
Let me ask you this. If you had $20 million in the kitty, if that was your budget for properties, what would intrigue you right now? If I had a lot of disposable cash right now, this is where I would be honing my focus.
Think about, what segments might there be less competition for deals because they have a bit of a stigma. And so I wonder about office, and would it be interesting to look at office properties where companies that have had planned to reduce their office footprint post-COVID have done that. And now employers are looking, how can we get people back in the office so that they can benefit from being together? That office could see demand increase. So it'd be kind of interesting for me if I had money to invest to look at an office property that's maybe undervalued where I could go in and get it and watch its value hopefully appreciate over time.
Going back to the stat I thought it was interesting, Manus, that the size of the deals has shifted from last year. We have a preponderance of investors looking at deals at the lower end, below 20 million sales price. The number of NDAs for deals of that size is significantly higher. It's 124. There's a lot of interest coming from family office, private capital, a number of non-institutional investors that are interested in jumping into the market. Very different buyer than we've seen in the past.
And I think it's probably influenced by the fact that people like that don't rely on financing for their acquisitions. If
Right.
you were needing $50 million or $100 million for a stabilized property and you're looking at a 7% handle rate, I think that that's probably throws a wet blanket on you to some degree. And I think if you need construction financing, that's even harder. So I do think that the cash buyer is king right now and probably is picking up nickels on the sidewalk right now when everybody's walking by them because they need financing and so forth. So that makes a lot of sense to me, and it may continue until we see rates, seriously come down. I won't get into this today, but maybe for next week. I think it was Commercial Observer, it could be The Real Deal, talked about how construction financing has gone from impossible to plentiful in the last 6 months, and we'll try to tease that back next week about where guys trying to put up 9-digit spec properties are now finding lenders all over the place right now, which is a great thing for the market.
Let's go into our transaction segments. We're going to start with who's leasing, and we have an interesting smattering here, taking us from biotech to tech to academia.
Let me start with what I thought was the greatest one of the week, and this comes down in Texas. I thought this was a very, very encouraging sign. Amazon has renewed for 5 years a 2-Galleria tower that comes from Noor Adashia, I hope I'm pronouncing that correctly, of the Dallas Business Journal. Even more encouraging, the firm is upsizing from 100K square feet to almost 250,000 square feet. Why did this catch my attention? Well, 3 reasons. One is very few firms have been 2.5xing their footprint over the last couple of years. So that's noteworthy on that basis. It takes a chunk of space off the market in the Dallas submarket, which has been challenged. There's been a lot of subleasing availability in that market. And lastly, one of the more underreported stories over the last 3 or 4 years is just how aggressive Amazon, Google, Microsoft, and others in the big tech space have been reducing their office space, not renewing leases. And hopefully, this is the beginning of a new upswing, people wanting more offices in the tech space, maybe driven by AI or something else. Let's hope.
They are adding about 600 additional positions, which is a vote of confidence, not something that you're hearing a lot of currently.
Big presence in Seattle, big presence in Silicon Valley. 2 years ago, they tell people they don't have to be there anymore. People move from around the country to other places. Now these firms want people back. They're probably getting some bristling. Maybe some of them are saying, let's use this as an opportunity to, increase space where the commutes are cheaper, time consuming, and where the workforce, has a lower cost of living. I mean, it could be as simple as that. Time will tell.
Right. And Amazon it's an influencer just like Google. So you have to think that other major employers are watching and thinking, oh, maybe we should, look at Dallas office space in a way that maybe they weren't before. So it'll be interesting to see if there are kind of ancillary impacts from big headlines like this that really kind of buck the trend of companies reducing their office space. And they're more than doubling it from 100 to 240K, which is amazing. And it's a beautiful building. I saw the picture of it in the article.
2 others very quickly in Boston. Love this one. Vertex Pharmaceuticals renewed 1 million square feet of life science space. The lease wasn't slated to end until 2029. Now they've renewed it until 2044. So a great story. That may become a trend too very soon. If people start seeing these renewal stories, it might be another thing that people are trying to get ahead of, which is maybe we are at trough rents, maybe we are at peak giveaways in terms of tenant improvements, and maybe some are starting to say, now is the time to strike, right? We may not have as favorable terms a year from now. Let's try to get ahead of this and renew. Crescent College and Career Prep, which runs a charter school network, leased almost 70,000 square feet in Southfield, Michigan. Why did this one catch my attention? We've seen a lot of stories lately of charter schools taking over unused space and in some cases buying the space outright, even paying north of $10 million for some of these spaces to expand their offerings. This is one of those cases, if you're a broker and you see some unloved space, the charter school may be the next phone call for you.
Turning to who's buying, let's break these down by property type to make it easier to digest. We'll start with office, and we have a couple of interesting office transactions. We're going to go there.
This one is in Beverly Hills, the 90210. Fashion Nova has purchased an office campus there that will serve as the new global headquarters for the firm. Fashion Nova paid $118 million to Tishman Speyer for the right to take over that property. And I knew nothing about Fashion Nova until I came across this article. They run Nova Social Club, which is a private, by invitation only, collaborative space where creators, wait for it, influencers, celebrities, and VIP guests can enjoy curated amenities. And in Mountain View, Divco West paid $108 million for a Google leased property at 600 Clyde Avenue. That comes from SiliconValley.com. That story is interesting for two reasons. One, on an assessment basis, this property is valued at nearly $200 million. So this is a deep discount, not something you see with Google leased properties very often. Often those properties are looked as like bonds, like you're investing in a Google bond. But in this case, Google has already said they are not taking the space and they're looking to sublease it, which means you know that they're probably not a long-term tenant.
Turning to multifamily, landlords are now offering these credit card style incentives like 2% cash back or points, gift cards, just for paying your rent and renewing. So they're saying it works. They're saying it keeps people there. And there's already about 2 million renters across the US that are getting rewards for paying their rent on time and renewing their leases. What has the world come to?
I'm not sure. I'm kind of speechless there, Diane. I might leave that for you. If it works, it works. It sounds great. What do you think?
Well, it's like the icing on the cake, if you're already there and you don't have to move and that's kind of nice and no other places are offering that, why not? It's definitely kind of an added incentive to stay put rather than looking around. So it's clever. I like it.
Well, Diane, we talked before about if you had disposable income, $20 million, where would you put it? I didn't weigh in on that, but you're going to find out the hard way very soon that the place to put it is student housing. Renewal rates are extraordinary. Occupancy is blown through the roof. There was no downturn in COVID, and they're able to push through, it seems like 11% year over year hikes in perpetuity. So I know that you're at that point where you'll start writing checks before too long, and you'll find out the hard way that that's a market that is quite hard to find losers in, honestly. We saw a lot of multifamily sales over the last 10 days, including 3 or 4 yesterday. Run through them in quick order. Independence Realty purchased Cortland Gateway from, you guessed it, Cortland. The story comes from the Tampa Bay Business Journal's Henry Queen. The price tag there, $61 million or $212K per unit. The sale represents a 21% discount to the 2021 price of $78 million. In Mooresville, North Carolina, a suburb of Charlotte, I believe, Inwood Holdings paid $237K for Braxton at Lake Norman, $55 million. And I love this one here. BlackRock Realty Investors acquired Alta Oxbow in Wayland, Mass. From Wood Partners. And the thing that caught my attention here is the property is a quote unquote active adult community for residents of 55 and older. And by the way, the price was $98,450,000 per unit. I got to ask this. Where is the inactive adult community for guys like me where, I don't want to be wrestled out of bed in my golden years. I want to be able to sleep late, have my cup of coffee, sit in my backyard. I don't know. I think that there's a market out there for the inactive 55 and over adult. What do you guys think?
I think that's an untapped market right now.
Yeah, you might be right. No water aerobics or bingo for you, Manus.
I think that most Americans are inactive, sadly. And, often I am one of those. And there should be a home for guys like me.
It was also interesting that they define it as an active community, but these 55 and older communities obviously are cropping up everywhere. I will say I visited a friend at one of these recently. It's like a country club, pickleball, tennis courts, 4 pools, a restaurant, a fitness center, a cafe. It's like you've, gone to the local hotel with all the amenities.
The Tampa Bay story is interesting. That's certainly one that I see come up as we look at growth in things like LightBox's environmental due diligence activity as an MSA that's experiencing higher than average growth. And funny side note, I have a friend who's an agent down in Tampa Bay, and she credits the growth of that area to Tom Brady's relocation from Boston to Tampa as single-handedly making that a cool metro to be in, to build in, to live in. Kind of an interesting sidebar there for anybody who's a Patriots or Tampa fan.
Last week, we discussed a story about a data center development in Mesa, Arizona, and a listener was interested in that particular story, pointed out that data centers are going to be a challenge for the energy grid, which we've talked about previously, and we've actually written some reports about that. They pointed to data from the Western Electricity Energy Council, citing that data centers, which can be built as quickly as 18 months, are going to far outpace the growth in the new electrical energy supply and transmission. I think, Manus, you talked about the need for a lot of land, a lot of space. You don't need a whole lot of population nearby, but you do need the kilowatts.
I do think that this is an area where there could be some bruises left on both investors, homeowners, and municipalities if people don't get this right. What do I mean by that? If a municipality sees a data center come in, start consuming energy hand over fist, don't have the grid for it, and don't price effectively how this property is being valued, how this entity is being taxed, how they're being compensated for driving up energy costs, whether or not that demand will be there 10 years hence. What if AI is a bust? What if they don't need all this energy that they've done infrastructure for? If places get this wrong, what you could be left with is sky-high energy prices, which makes operators of multifamily and hotels really puts the thumb on top of the homeowner as they see utility costs skyrocket. And lastly, these things don't employ a lot of people. It's not like you're bringing in an entire new tax base to run these things. They're really manned by small teams of people. So I know that in Virginia, some of the municipalities are trying to get ahead of this with long-term contracts and negotiating them in advance. I think every neighborhood has to do this. Otherwise, they're risking a real excessive tax on everybody that does business or lives in their community.
Could this potentially, and I'm talking about data centers way out where there is available land, would we see more kind of co-located data centers with new wind farms? But a lot of, that's complex. It only works if there's available land. It only works if, you don't need miles of transmission lines. And obviously, if zoning allows for it.
Manus, there's a buzz lately about post-Labor Day return to work. You've heard it on the media. You've heard it probably at the water cooler. And many companies obviously are advocating that in the coming weeks. But there's an interesting outlier. And I know we talked a little bit about Starbucks last week at the end, but we didn't really discuss that the CEO is going to be doing the super Uber commute by private jet. That only is needed.
I'm not a fan, I have to say. I think that this particular CEO has had a lot of success in the past, so maybe it's foolish to bet against him. But I do think that walking the floor, knowing your employees, knowing how they live, knowing what the vibe is on the floor is important, and just dropping in and dropping out, kind of not my vibe for leadership at a company. That's my personal opinion. But what I'm really waiting for is for that photo to come out of him on the private jet drinking chock full of nuts coffee. That's the one. That's the with the TMZ, whatever it is, reveal that I want to see down the road. That on his private jet, they don't serve Starbucks. They serve Dunkin' Donuts or some other kind of swill.
I don't know, Manus. I'm still digesting your comment from last week that you think that the Greek diner coffee in Manhattan can compete with Starbucks. I'm a coffee snob. I need frothy milk on top. It's even better if someone draws a pretty leaf on it. Starbucks lost me when they got so crowded with drive-through orders and app orders. So when you go on, you don't get the customer service anymore. So if I'm paying a premium, I want face-to-face. I'd rather go to a local coffee shop, but we'll see if the new CEO does something to improve that for me. I threw my gold rewards card away years ago.
Ah, the rebel, Dianne.
That's a wrap. Thanks to our producer, Josh Bruning. Join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels. Send us your comments or questions to podcast@lightboxre.com. Thank you for listening. Have a great long weekend and have a great week.